Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Donald Trump doubles down on his pledge of more tariffs on China, Canada and Mexico. The dollar gains and European futures are lower, but US futures edge higher. Israel and Hezbollah are said to be close to finalising a ceasefire deal, with the Israeli Security Cabinet set to vote on the agreement later today. Plus, the EU proposes sanctions on Chinese firms it says are aiding Moscow's war effort. This as G7 foreign ministers also weigh more measures targeting Russia.
Let's do a quick check on these markets, because maybe a little bit muted reaction in U.S. futures, maybe a little bit muted in Asia, but here's where you're getting most of the pain. Eurostoxx 50 futures down a whopping 0.8%. The FTSE 100 right on its heels, down by about 0.4%. As Anna mentioned, that dollar strength across every major currency, the Canadian dollar, the Mexican peso, and of course the Chinese yuan, not to mention the euro. The Bloomberg Dollar Index is flying this morning. The 10-year yield hovering around 4.28. We're going to dive into these market dynamics. The countdown to the opening trade starts right now.
Tuesday morning, good morning. So the narrative yesterday was Scott Bessent, the incoming Treasury Secretary, would basically put guardrails around the Trump administration when it comes to the most outlandish and outrageous economic policies that could be potentially put in place. The headline this morning is that Trump is back, he's in charge, and the tariff agenda is firmly back on the agenda, and we should react to it. Just been hearing Kriti talk about the fact that there is a market reaction. You're getting it in the currencies, but you're not getting it in US futures. And why on earth are European equities down as hard as they are this morning? I don't understand the market reaction this morning. I don't understand trading headlines in this way, and I don't understand the headline I read first thing this morning that markets are roiled. To a certain extent, yes, but really?
Some of that roiling's been unwound, I think, is perhaps the solution to that one. But yes, some of the initial moves we saw in the Aussie dollar, fixed futures, in stock futures, in gold, all unwound to a certain degree, as if we were trading the headlines, as you describe, as we remember from the first Trump administration. But maybe the market is going to deal with these quite quickly. We did see the Mexican peso drop to close to a 2-year low. We saw the Chinese yuan just edge lower, which in itself is interesting, as if the PBOC is trying to draw a line in the sand and say we are not going to respond to this in the way that you might expect us to. The dollar is stronger. That is having a little bit of an impact on some of the metals prices. But to your point, we saw these initial moves. We have to get used to trading the headlines. This is President Trump, and we know what that means. But we don't have to linger, perhaps, on the effects for too long.
But I think the reason that maybe Europe is taking a bigger hit is, one, because we don't actually know the specifications around what the tariffs actually apply to. There's always carve-outs. There's always layers. This is on top of the existing tariffs that are already in place.
But he didn't even mention Europe.
No, but he will.
But
is that what we're trading on?
I think it is.
But in the first Trump administration, when you look at the market reaction, Europe always took a bigger hit. Even if it was China and the U.S., it always took a bigger hit than American assets and Asian assets, despite simply because it doesn't have the defensive bid into the U.S. assets that so much of that got.
And you look at the trade deficit between Germany and the United States, and that'll be what's on people's minds, won't it? Because they know that that's something that Trump cares about, as well as the stock market reaction in the US. But these are things that drive his thinking. And so I suppose that's why Europe takes this more seriously.
But this is a very specific... He's talking about very specific things. He's talking about the border north and south. He's worried about immigration. He's worried about fentanyl. These are unrelated subjects to anything in Europe. Are we trading...
Just a reminder of his operating strategy and the fact that this comes at strange hours of the day. That's the other thing that used to happen in the first Trump administration.
That's also true.
That you have to be on guard 24 hours because it comes on social media.
But US futures higher. The dollar's moving, obviously. US futures are higher. Europe is still down by 0.8%. Does that close as we approach? In the next hour, does that close? I
think the other piece of that is yesterday Europe outperformed every other market. It was higher by 0.8%. So I wonder how much of this is just simply paring back yesterday's move as well.
We will talk more about that in just a moment as we approach the market open. 55 minutes until we get there. The other factor we need to fold into all of this is what is happening on the geopolitical story. We spent last week talking a lot about what was happening in Ukraine and how escalation, de-escalation could ultimately work. We're now looking at a potential deal, we think, surrounding Israel and Hezbollah. We've been here before. Is this going to be something that is delivered upon? This feels like we're further forward than we have been for a while in terms of making these talks work. But do we need to believe it? Should markets price it until we get it?
The timing is really fascinating here. And to the market's point, you're not actually seeing a move in the commodities to the extent that maybe we have on Middle Eastern headlines in previous form. To me, what's interesting is that in the last couple of months, you have heard comments, I believe the Washington Post reported this as well, that the Israeli officials actually wanted a ceasefire deal with Hezbollah as an early foreign policy win to Donald Trump. That's a quote from Israeli officials quoted in the Washington Post. So I'm curious that this is happening a couple of months ahead of Donald Trump actually taking power, if that is indeed the political landscape. We'll see whether or not this, of course, comes through.
Yeah, we did see a substantial move in oil yesterday, didn't we, on the back of this? And on the expectation, as you say, it is still just expectation, and we've been up this hill before, but maybe we attach more credibility to it. And we are just, quote, unquote, just talking about a 60-day suspension, so where that goes. But the fact that the oil price reacted so severely tells me that people are taking this seriously. It was above $75 on Brent before these lines dropped, and then it was 73 by the close of yesterday. But still big questions. You know, the Israeli cabinet can vote on whatever it wants, but we still need to get Hezbollah's, OK through the Lebanese government and the like.
It does. It's a very incredibly complicated process. And drawing a line between it and what happens with oil, does this affect the Houthis in terms of what happens with the Red Sea as well? How will that affect the story in Gaza? There's lots of moving parts to go around this.
Yeah.
Really hard to price in. And therefore, I wonder whether the market beyond oil does price it in or just ignores it until it knows exactly what it's ultimately dealing with.
Well, I think we've had a real kind of narrative shift of foreign policy now driving some of these markets and geopolitics driving some of these markets. We know that we were kind of on edge waiting for the tariff story, but now not only the approach to the Middle East from the new Trump administration, but also to Ukraine as well is a big one, especially how the Europeans are going to be combating maybe some of what the headlines coming out of the U.S. as well. The EU is really getting on top of this, though. They are now looking at sanctioning Chinese officials around their potential help in Russia when it comes to the war in Ukraine. I think this is really crucial as well, because this will be a key topic at the G7 ministers meeting later today.
Yes, and this is specifically around those Chinese actors who've helped Russia supply drones and other things. Also thinking about increased restrictions on Russian oil tankers. This feels quite iterative, though, doesn't it? Because we already have substantial restrictions on the way that Russia can transport its fuels and the role it can play in the international market. So that feels like a sort of additive sanction. But we watch the G7 nonetheless.
We will, with a great deal of interest. Let's talk about what we've got coming up on the show and figure out what is going on here. Madelaine Jones, Oaktree Capital Portfolio Manager, is going to be joining us. Julius Bendikos-Mercer, European Head of Macro and Dynamic Asset Allocation, joining us a little bit later. We need to talk about crypto. America is charging ahead. The UK taking a more cautious approach. Matthew Long, UK FCA Payments and Digital Assets Director, will be joining us for a broadcast exclusive, Kriti. Broadcast exclusive.
It's an exciting conversation, certainly one that we're going to be keeping a very close eye on. And we'll talk about the daybook as well in terms of what else we've got in the next 24 hours. We're, of course, keeping our eye out for all the headlines on both sides of the Atlantic, arguably both sides of the Pacific as well. But in the meantime, we get U.S. new home sales data, consumer confidence, a slew of data coming out of the U.S. at around 3 p.m. UK time. But then I think a lot of the focus is going to be on that G7 foreign ministers meeting, 3:45 p.m. UK time. And then, of course, the FOMC at 7 p.m. Those minutes, how are they talking about the election? We're going to find out.
Yeah, were they talking about the election at all? I mean, that probably not, seems to be the conclusion I get from some of the reading. But this, just as a reminder, this is when they did 25 basis points after the one they'd done 50. And this was the one that was hot on the heels of the election, and where actually it wasn't the moves that got the headlines, it was the defence of Fed independence that really got the headlines. Now, is that something that the FOMC picked up on, or was that a different conversation that Powell had been having with others? Because it was clearly planned. He clearly came out with a message on Fed independence that day, didn't he?
He did. You do wonder whether or not there was this whole idea that once we had the cabinet in place, once we were into the kind of grey area, end of the Biden administration into the Trump administration, that we would refocus back on the data and that the Fed become more important once again. We don't seem to be talking about the Fed as much as we did recently. Does that happen with Trump trading, with Trump trading headlines, headline trading Trump? I don't know.
Yeah, if the Fed won't talk about Trump and the market is all about Trump.
Yeah,
kind of the market manages to put the Fed aside. Yeah.
Well, I think this question of independence is a really crucial one, because something that we haven't talked about, maybe got hidden into the Lutnick and Besant kind of narrative and headlines, was that Russ Vought was chosen to be the head of basically the executive branch budget. He is the writer of the Project 2025 that really endorses and helps create more executive powers in the branch. So that's something that he now has on his team, despite on the campaign trail trying to distance himself from that. I thought that was a key kind of piece of his strategy as well.
And we're all chatting about where Lighthizer fits into all of this as well. We were talking about it before we came on air. And kind of does Lighthizer have this kind of overarching trade strategy which basically dictates everything? And it goes from Trump to Lighthizer to ultimately all the other branches of government, and that is how this tariff policy is dictated. I don't know, but and that's the point. We don't know yet.
If that's actually effective. I was just in Brussels, though, and last week, and a lot of what they were talking about was the one they were asking me about these cabinet picks. I didn't have an answer for them. But then they also were talking about the fact that they think that there's inefficiencies going to be baked into this government. I think that's where Trump really has to show that these picks can't actually execute what he wants them to execute, and there's a chance that they may not be able to.
Well, that was the problem with the first
Trump
administration. He's trying to deal with that in the second Trump administration. We'll see how effective, as you say, he potentially could be. Let's talk about some of the other things you need to know this morning, running through some of the other news. The former German Chancellor Angela Merkel and the Bavarian Prime Minister Markus Söder say they are open to reforming Germany's strict borrowing limits in a departure from the traditional stance of the conservative Christian Democrats, who are leading in the polls ahead of an election which we now know is going to be taking place in February. The rules established following the global financial crisis limits net new borrowing to no more than 0.35% of GDP to help keep the budget deficit in check. Will Germany be writing a check if that were to be limited? We will see. The US Justice Department has ended its pursuit of criminal charges against Donald Trump, dropping 2 federal cases due to his re-election and the department's policy of not prosecuting sitting presidents. The department has left open the possibility of reviving the cases once Trump leaves office. And Formula One is expanding its grid to make room for General Motors' Cadillac brand and a new American team in the season 2026. The approval ends years of wrangling that launched a US Justice Department investigation into why Liberty Media, the commercial rights holder of F1, would not approve the team initially started by Michael Andretti. There's only one American team on the current F1 grid, and it does not field American drivers. I have struggled with this one all morning, trying to persuade you two to talk about it. Mainly is the issue. There's a lot of money involved. Basically, we haven't had a new team. We've got 10 teams. They're trying to widen it out. This is a sport that's gaining huge popularity in America. And we've seen Drive to Survive. We've got a Las Vegas Formula One race, which has just happened. It is becoming more and more popular. But it's been a huge fight, actually. The thing that surprised me once again out of this was that that F1 has not wanted this, that there's been a limitation. Actually, you would have thought you would want this.
Yes.
And you would want to open up America to more F1, precisely.
Yeah, absolutely. I mean, anything that makes it look like America and all of the money that America has to put towards its sporting interests is going towards F1 is worth note, isn't it? I know Kriti had a different car story on her mind, you see, this morning. That's what we're up against.
I was trying to bring it back to Taylor Swift, but maybe I'm not going to do that.
Wrong audience. You bring it up to Enrique, and I'm all about it. But I looked up the numbers because you said it's a money story. It's all about the numbers. So I saw the $3.2 billion approximately, some of the sources varied, of the value of the F1 industry. Compare that to NASCAR, for example. I'm Southern. I'm from Texas, so this is a natural kind of competition. About $3.8 billion. So not far off from kind of this cultural norm in the South. I was pretty surprised by that stat.
So that's a global number, though, and that's a sport that's purely limited to the United States. F1 wants some of that NASCAR audience. It also has a higher female audience. It has a younger demo. These are the audiences that advertisers, etc., really want to go after in a big way. And if you can build that audience at that within that younger generation, this is something that has longevity to it as well.
Liberty Media has a lot to answer for, doesn't it? Like pushing the popularity of something that was already huge in Europe into the US market in a way that we haven't seen before. And
it was interesting. It's been in Asia. I think the real key moment was the Drive to Survive series that Netflix put on. So this has kind of become a Netflix event as well. And it's interesting how other sports are trying to mirror that process. You look at what's happening with rugby and other sports.
I was like, how is F1 succeeding where maybe soccer hasn't in the States? I guess that's what's surprising to me.
Because we call it football, maybe is the first.
Okay, I don't have the time to get into this conversation.
We're already lost in translation. It's 7:13 this morning here in London. What else is coming up on the programme? We will talk about French politics. Coming up, Marine Le Pen threatens a vote of no confidence if budget demands aren't met. We will check on the state of play in Paris. Plus, Germany sees more manufacturing job losses as the country heads towards crucial early elections. Up next, markets continue to digest Donald Trump's big talk on tariffs. We will dig into some of the market moves in detail. And if you have any questions for our guests, of course, do get in touch. IB plus BBTV Go is the function on the Bloomberg terminal that you can use. This is Bloomberg.
think, again, you can expect this to be very, very transactional. And I think that's part of the reason for announcing it well before he's even in office. I mean, he is clearly looking for, and I would say, you know, Canada and Mexico to come to him with offers of things that they can do.
That was Jennifer Hillman, former US International Trade Commissioner, giving her take on the latest Donald Trump tariff plans. We continue to watch what is happening here. There's a briefing taking place out of China. We'll keep an eye on that. Let's get more on how the markets are dealing with all of this and how the US president-elect's latest tariff threats to China, to Mexico, to Canada are being priced in. Valerie Teitel's here with more.
Guy, a lot of the reaction has been focused in the FX space. Not surprising, given they're most vulnerable to these tariff threats. We've seen the dollar strengthen across the board. The Mexican peso weakened by 1.4%. Dollar CAD also moving up by nearly 1%. And also weakness in the Chinese yuan, even with a stronger fix from the PBOC. So is a clear reaction for a stronger dollar in the FX market. What's a bit more confounding is the reaction in the equity market. If we flip on and just take a look at how we're faring, S&P futures basically unchanged since this announcement. We are seeing a big downside when it comes to European stocks, though. European 50 futures down 0.6%. Perhaps they're bracing for their own memo from the president-elect Donald Trump. I also have up here CSI 300 futures. Those are in the green, even though we did hear new tariffs on China from the president-elect overnight. Perhaps the equity market in China is bracing for some more policy stimulus on the back of these Trump tariffs. As you mentioned, we do have that policy briefing taking place as you speak.
Okay. Valerie, thank you very much indeed. Let's talk more about this with the incoming President Trump creating a little bit of early volatility. Let's get a view from the credit markets and figure out what is happening here. Madelaine Jones is portfolio manager at Oaktree Capital, where she manages the European high-yield bonds and European senior loan strategies. Good morning.
Morning.
UniCredit, which in some ways is a bottom-up kind of do the nuts and bolts analysis of what is happening within individual companies and sectors type space. But nevertheless, it's the top-down headline Trump tariffs volatility story reach into your world? And are we basically, even in credit, set for 4 years of trading headlines?
Well, I think that you're right to point out the bottom-up fundamental nature of what we do. Whatever the headlines are, we're constantly churning around in our minds. What does that mean for individual companies, individual balance sheets and their prospects? We're in credit, so we don't need the world to be perfect. I think that really makes a difference versus equities, where you need that growth trajectory. In Europe, we think that the growth trajectory is clearly more challenged, but we don't rely on that. And as long as we can find a way for the corporate balance sheets to make sense, then there's an investable prospect for us. It's where you want to tilt your portfolios with all the macro and the headlines that are going around. You know, clearly we look at places like auto sector, cyclicals, and the export side of the European economy to be more exposed to the latest Trump trade headlines. But that leaves lots of other places which are more domestically focused where you can find attractive prospects. But it's all about that individual bottom-up balance sheet by balance sheet analysis.
Does that balance sheet by balance sheet analysis get affected by what happens in the US 10-year? And if the US 10-year continues to climb 5%, 5.5%, how does that change the narrative?
It can do. I think the market is more on the other side of thinking that, you know, rates may be higher but not excessively high to really challenge company balance sheets. And we're coming from a context where in the high-yield bond market, whether it's US or Europe, actually balance sheets are very good. A lot of it's double B quality now. Over 50% of the market's double B quality, which means that they're well placed to withstand, you know, higher rate environment. Whether the assets recorrect because that is another thing. But I think that's a good thing to start with a base like that. If you're thinking that rates may be higher for longer, it means it's still investable. The fundamentals should be fine for the overall asset class. For credit, you know, rates being higher for longer is an attractive prospect because we can get really good yield.
OK, so that's a positive. Madelaine, when you think about, so clearly you've emphasised the bottom-up nature of the analysis that's required in credit, but when we have a top-down story that is all about more tariffs being applied, volatility in the global economy, perhaps as a result of that, Do you look for companies then that have ever stronger balance sheets just to withstand the unexpected? Because we know from the first Trump presidency that withstanding the unexpected is kind of the name of the game.
Yeah, well, you should always do that in credit. You should always be building your analysis on a cash flow assumption and a forecast which can withstand shocks, whatever they are, and you just don't know where they come from. But the better quality the balance sheet, the more resilient they're going to be. The better quality the company, the right sector, all these things on your side, access to liquidity, all these things will make a difference to the analysis we do, whether we want to back that company or not.
But do you feel there is complacency in a market where spreads are as tight as they are, going into a period where we expect volatility and the unexpected?
Well, if you unpack the spread, actually, you'll see there's quite a dispersion within that. You look at some parts of the, auto supply market, auto market, they're more dislocated. Of course, real estate is very high spread. So, within that, it's not one uniform spread context. But yes, I think we are entering a market where, with the spreads on an overall basis getting quite tight, you have to be very careful on your credit selection. Credit selection is going to matter fundamentally, more so as we get tighter, as we get more volatility, as this environment changes. Getting the asset selection right is increasingly important.
Part of your role is, and correct me if I'm wrong, is to be co-portfolio manager for the global high yield strategy. And when I think high yield, I immediately think some of those oil credits, and specifically in the United States, but in Europe as well. That is a part of the world and a sector story on both sides of the Atlantic that could be deregulated quite quickly in this new administration, but also as Europe kind of plays a little bit of catch up. Does that change your exposure to oil credits, the triple Cs I'm thinking about in the States, for example?
Yeah, all of this will come into play of deciding whether there's a different composition in a portfolio we want to take. And we were looking at that all the time, whether we tilt more towards the US or Europe, whether we want cyclicals or defensives. I think right now our posture is, with spreads being tight, we want to be quite defensive in our portfolios. We're expecting more volatility. We want to be priced to access that volatility where that comes from. But again, piece by piece, credit selection, more than actually top-down or industry sector selection, top-down analysis is going to be piece by piece, idiosyncratic, name by name.
So what does that defensive look like then? Are you going up in credit quality? Is there a risk of fallen angels? I mean, what does that actual pivot in that defensive strategy look like?
Yeah, again, you're talking thematics, and you're wanting to look for these sector trends, but it will come down to individual balance sheets and how strong they are. But, within Europe, for example, we've steered away from auto supplies for quite some time now, not just because of the threat of trade tariffs, but because of Germany's position in the world of being a car exporter, being challenged by China now, who was once their recipient of demand. All those elements are leaning us away from autos. At some point, that may change. There are good companies in there. There are auto suppliers who can withstand a long-term, and can reposition themselves. Might be quite interesting. But we've made positional changes away from industrial Europe, away from autos, sectors like that, because we do see them being structurally challenged.
The China read-through is certainly one that's having ripple effects throughout many sectors. Madelaine Jones, portfolio manager at Oaktree Capital, joining us around the table this morning. Guys, I believe we're also getting some headlines coming out of the Chinese Foreign Ministry. Madelaine was just talking about the China read-through. Some comments.
Yeah, absolutely. The Foreign Ministry saying they will respond later on Trump tariffs. So that's the holding statement, I suppose you would call it. The PBOC has already slightly responded by fairly aggressively pricing the yuan and resisting any yuan downside, or not too much of it anyway.
These are the early skirmishes. How do you respond to Trump? How transactional is he going to be? Do you respond aggressively or do you wait and see? All of those, I think, are issues that we need to kind of see how the Chinese deal with.
And that's just the Chinese. We've got China, we've got Mexico, we've got Canada, Mexico, and several others to deal with as well. More after the break. This is Bloomberg. 30 minutes from the start of the opening trades across Europe. When you look at the futures picture, seeing a little bit of a mixed one. I'm not sure how to read this because you are seeing red on the screen in terms of some of the European market action as well. Your Stoxx 50 futures down by about 0.6%. The FTSE 100 down by about 0.3% as well. Just 30 minutes ago, that was a much more aggressive sell-off. So you're seeing some of those losses getting paired, at least pre-opening trade. That being said, compare that to what you're seeing over in the States. S&P futures are flat at the moment. They were higher about 30 minutes ago as well. So again, pairing some of the gains on the U.S. side. A lot of that is coming down to how you interpret the comments coming from President-elect Trump. And we're getting immediate reaction right now. The Chinese Foreign Ministry briefing is underway in Beijing. You're seeing that live on your screen at the moment. It looks like they're choosing not to currently respond on those Trump tariff comments, saying that they are open to a dialogue in principle when the time comes.
Yes, saying that they will respond later on Trump tariffs, but when asked if they're talking to the Trump transition team, saying they're open to a dialogue in principle. Because the transition takes some months.
Yeah.
This is where we end up, isn't it?
We're in this kind of grey zone.
Power transfers in a strange way. It seems to transfer before the actual office transfers, to some degree, of course.
Well, the market's a discounting mechanism. It's looking forward. I guess you could maybe apply the same thing to the politics right now as well. This is what I'm going to do. You need to price that in now. But the Chinese don't know yet, do they? They can't figure it out. This is an early salvo, an early indication potentially in a very specific area relating to fentanyl.
It is very specific. It's also on top of what the already pre-existing tariffs that are implied at the moment as well. So there's also a question of how that gets turned around. There's also the question of Canada and Mexico, because at the moment there's also a USMCA deal, which, by the way, President-elect Trump renegotiated in his first administration, that I guess is now getting renegotiated. So we have to see what the international reaction is.
Apparently Trudeau got straight on the phone to Trump when this came out and said, look, can we talk about this? Because actually the number of people crossing our border is very limited. We are very much on board with the fentanyl story. Why are you talking about
this? And Biden has been recently praising the Chinese for the progress that has been made in the fentanyl trade.
Yeah.
So that's a different viewpoint.
The common thread between China, Canada, and Mexico in terms of imports to the United States is autos. It's vehicles. It's cars. It's car pieces. So that's going to be an interesting piece. Maybe that might show up at the opening trade. Let's get in another voice here. Bloomberg's Jill Deese is, of course, following the story for us out of Hong Kong. Jill, I'm sure you're watching this with as much intrigue as we are here in London. Walk us through the thinking behind this move. Do we have any insight on what this means for existing tariffs on China?
Right. Well, I think, as Guy mentioned, a lot of this does seem to be tied to a lot of Trump's concerns over the fentanyl crisis in the United States. Though I think, as you guys were just discovering, it's a bit of a sort of bizarre coming from Trump, at least on the China-Mexico side, saying that he'd be implementing higher tariffs there just because that was such a big focus of the first Trump administration, is trying to bring down those numbers. And obviously, as the Biden administration had said, maybe there was some progress there, although maybe we're getting a bit of political whiplash here. I think on the China side, obviously, Trump once again mentioned, the fentanyl crisis. He's saying that China just wasn't really doing enough to crack down on bad actors and imprison bad actors within the fentanyl industry, and that's what's really at play here. But I do think that while it's kind of a bit of a jolt here to hear this so long before Trump actually takes office in January, it's really still not that much of a surprise that he'd been targeting China with new tariffs. I mean, he did say pretty famously during his campaign that he wanted to increase the amount of tariffs on China. I think the question here, though, is how this actually still factors into those pre-existing tariffs that the Biden administration has kept in place. We'll have to see what kind of details we get there, because right now we're still just don't have a ton of details on how this actually applies to those goods beyond what we already have on China.
Yes. And what has been the response then from these targeted partners? We mentioned that Justin Trudeau was on the phone or liaising at least with President Trump as pretty soon after this commentary was released on Truth Social, Jill. And I know that we've heard from China just in the last 5 minutes or so, that press conference just coming to an end. What have we heard?
Yes, that's right. So, as we mentioned, Justin Trudeau really getting right there on the phone with Trump saying, look, we haven't, this isn't as big of a problem for the Canadian-U.S. border as it is for the Mexican-U.S. border. I think he's, seems like he's really trying to figure out what's going on here. Maybe we'll hear a bit more out of Canada in the coming days. We did hear from the U.S., the Chinese embassy in the U.S. Right after those comments were released, just saying that, it was kind of reiterating some of those previous remarks that we've heard from Beijing, basically saying that, a trade war war, a tariff war, really hurts, everybody here. It doesn't help anyone there. I mean, at this point, though, getting those comments from the Foreign Affairs Ministry just saying they need to take a look at this and then they'll get back to everyone a bit later kind of shows that, at least these countries, I mean, they've been preparing for the prospect of a Trump 2.0, a returning Trump administration. But, I mean, it looks like we're kind of back in Trump land here. I mean, we get announcements on Truth Social or X or wherever at all times of day or night, and then you just kind of have to wait to see how exactly these places are ultimately going to, respond to these things.
Jill, thank you very much. Bloomberg's Jill Desis with the latest on these trade conversations after we've heard from President-elect Trump and heard a little then in response from some of these trade partners. Another big story overnight that we were covering at the top of the programme is the latest developments and expectation of developments in the Middle East. Bloomberg understands that Israel and Hezbollah appear to be moving toward a ceasefire deal that may be imminent. Let's bring in Bloomberg's Dan Williams, who's in Jerusalem for us and can bring us up to speed. So how close are we to a ceasefire deal here then, Dan? And what would it look like? I think we understand a little about what it could look like.
It would appear close, very close potentially only hours away. A dramatic day ahead of us in this war, now in its 14th month. Development that will affect one front of this war, the Lebanon front, the second front of a war that began in Gaza in October of last year and has spiraled and expanded really to become a regional war between Israel, Iranian proxies, and between Israel and Iran itself. We understand that this afternoon the Israeli Security Cabinet will be convening to sign off on a truce deal being promoted, being mediated by the United States to a degree with the involvement of France. Given that approval, and it's a fairly guaranteed approval, this would apparently then go back to Beirut for the final approval of Lebanese officials who've been serving as mediators between those mediators and Hezbollah, which is blacklisted in much of the West. So indeed, in the coming hours, perhaps by tonight, we may be hearing that this front has been calmed.
OK, we hope that there is progress being made. That is what we're looking for here. But there still seem to be some significant obstacles. What are they?
Well, the obstacles, we've had optimistic predictions before. This time, it would appear there's more substance to them. The obstacles have been over what becomes of Hezbollah's deployment, what becomes of Hezbollah's future attempts, should it attempt to rearm, regroup, redeploy, having taken quite a drubbing, especially in the last 2.5 months of fighting with Israel. Israel wants not only the implementation of a 2006 United Nations Security Council resolution that ended the war of that year, meaning a distancing of Hezbollah from the Israeli border and moves to prevent it rearming. Israel actually wants a guarantee that it could resume military strikes against Hezbollah should it deem Hezbollah to be in violation of that truce. So far, the Lebanese and Hezbollah have not been happy about that condition, at least not it being written into the contract, the treaty, whatever deal is being prepared. But it would appear they may have relented because it seems the Americans, the French, and the Israelis are optimistic that this time there could be movement.
Bloomberg's Dan Williams in Jerusalem. Thank you very much indeed for updating us. We will watch for news, keep an eye on the tickers to see what happens here. The oil market's certainly on tenterhooks, waiting to see what kind of a deal gets done here, potentially a deal getting done here. Does it change? How does it change the narrative, if at all?
Yes, if at all. We saw the oil markets reacting to this, even though there may be absolutely no read across into other areas of violence, into Gaza very specifically. Really interesting to see, though, how various power bases within the Middle East are rethinking, repositioning ahead of another Trump presidency. And again, we come back to this point of, Trump's not in power yet, and yet we see his influence around the world. We heard from Iran just last Tuesday, about the way they're changing their thinking on what they're doing with nuclear energy. And you wonder how we will see these players reposition as we head towards another Trump administration.
The narrative seems to be, from a foreign policy perspective, that you are reacting to Donald Trump. At the same time, in the background, there's so many other things going on. De-dollarization, getting exposure away from the United States. This was a conversation in Brussels as well as how do you get away, especially in the defense industry, for example, on exposure to the U.S., on exposure to other parts of the world as well, at a time when everyone kind of has fiscal handcuffs, and it also feels like American corporates are where they can incentivize the most bid.
Getting away from the U.S. defense industry has proven to be very difficult for Europe. Buying U.S.
they're
arms.
Try.
They're going to try, but Europe doesn't have the capacity. Europe is building the capacity, but that is something that takes a long time. So if you want to rearm Europe, where does the kit come from? A significant portion of it's going to have to come from the United States. You were flagging a piece earlier on suggesting that France maybe is dropping its 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 annoyance at the fact, its restrictions on the fact that Europe is going to buy a certain percentage domestically and from the United States.
Yeah.
Because you can't rearm Europe without that industrial base that comes from the States. And that's one of the huge problems that Europe faces.
So basically this idea that American corporates like Boeing, like Lockheed Martin, like others, Raytheon, for example, can access some of the subsidies in the EU. But don't we talk about this a lot in the auto space, in the defense space, in the oil space? How do you incentivize without subsidizing? And no one's been able to figure that out just yet?
Well, the US and Europe on different pages, it would seem, on that front. And we've seen that over the last couple of years ago. We are in an increasingly sort of political global economy, aren't we? Coming up on the programme, investors on edge as Donald Trump aims fresh tariff threats at some of America's biggest trading partners. We will look at which European stocks could be most exposed ahead of the opening trade. That's next. This is Bloomberg.
15 minutes, the equity market open here in Europe. Bonds starting to trade. This is the picture you see in front of you, both in terms of the futures and in terms of the bonds trade. Keep an eye on France and what is happening there in terms of the spread over Germany. That is widening out. Europe does seem to be lower this morning on the equity front. Why is that? Not entirely sure. It does seem to be a sense of maybe Europe's just next on the tariffs conversation. That is, I think, is what we're watching for quite carefully at the moment, trying to figure out what is going on. Anyway, Kriti, that seems to be the narrative at the moment. I think we're struggling to put our finger on what is happening here. There are some fundamentals, though, we're watching in Europe, particularly when it comes to the M&A story.
There are, and it's a fascinating one, this concept of being more competitive, being more dynamic, especially with the United States kind of maybe on the offense at the moment. It feels like it's showing up in the bank space most clearly. Of course, in the last 24 hours, we had a very clear message from Andrea Orcel that he's looking to expand in Italy, that bank consolidation story. To me, I'm having a little bit of deja vu because it's very similar to the BBVA story in Spain as well, which is that you start to have this question around how much domestic exposure you have when a bank gets bigger and bigger, you have less domestic exposure. And that maybe not sitting right with the authorities. That was BBVA's problem. It kind of sounds like that's UniCredit's problem as well.
Yeah, Orcel definitely saying yesterday we could not afford to sit out of the domestic M&A story as it developed in Italy. So wanting to be part of that, which is perhaps the link you're drawing. Interesting that we have heard from the Italian government, no sort of final verdict on what they think of UniCredit going after BPM, but saying there's no verdict yet. But the finance minister, when asked about it, reminded a group of reporters about the veto powers that the Italian government has on all of this. And they've been trying to cobble together a different deal.
This is just a mystery to me. Here is a Europe that says we desperately need to sort our capital markets out, that we need cross-border banking, we need cross-border financial services, we need cross-border markets.
That's what we heard from pan-European voices.
That's what Lagarde was talking about the other day, and just simply saying, why are we struggling to catch up? Why are we struggling to not compete with the United States? Because of all of these things, and yet...
So the Italian government stealing a page out of the German government's playbook, is that...
And the French and the Spanish as well?
Yes, that's absolutely true.
And you wonder how, yes, I mean, cross-border M&A is difficult, but it seems domestic M&A is
even
also
more
difficult. Let us talk about what's going on in these markets then this morning. We are joined now by our Markets Live executive editor, Mark Cudmore, for 3 minutes on the markets. And Mark, let's start with the way we have been reminded in a way that really took me back to 2016 and that period about what it's like to deal with another Trump administration, even before we are in another Trump administration. The way the news comes, the time of day the news comes, and the way that the markets have to trade those headlines.
Absolutely. Welcome to the new old trading regime. It is headline trading, absolutely back and dominating again. The markets were trading the kind of the Besant relief rally, that idea that, is a little bit more calm in markets, that there's a sensible Treasury Secretary choice. And then suddenly, out of nowhere, unexpected on timing, we get these very, very aggressive tariff headlines and a little bit out of context. And I can tell that the analysis has been so taken by surprise that it's still confused out there. These tariff headlines came in context of the drug threat and therefore the border focus. And that's why Canada and Mexico were mentioned and not a talk about Europe or Japan or any other country. And therefore, those omissions shouldn't be excited about. This is more about highlighting about how these threats will come and that tariffs will be announced first and negotiations to follow. So that means even if they're only a negotiating step, we have to go through the headline trading and the uncertainty first.
The bit that I'm really confused about this morning, Mark, is that Europe is down quite hard and China isn't.
Yeah, China isn't, I guess, partially because we've talked about this a lot. It is priced in, a disconnect from the U.S. for a long, long time. It is priced in the new regime. Long before, we knew Trump was going to be president, it's priced in the fact that it has to disconnect from the U.S. economy on a direct trade basis. So it's already priced in quite a negative world. It's the rest of the world that's been priced more rosily. So China being a little bit more resilient makes sense there. And there's an acknowledgement that the government in China has done a lot of policies recently to kind of slightly support the economy at the margin. So it's not that it's priced particularly negatively or positively. It's priced about right for this new kind of world. I think in Europe, there's still a more kind of growing downside. And remember, if this aggressive policy on trade is going to happen, this is going to be really bad for Europe. Germany is one of the most open economies in the world. It is going to be affected. If Trump is going to add to the cost of trade for companies and business and countries everywhere, that is problematic for Europe.
Mark, what about the bond market here? We're looking at a 4.29 on the 10-year yield. If tariff threats are supposed to be inflationary, is it priced in the bond market too?
No, it's not at all. I think there's a couple of things here. I think also the fact that, Besant wants to kind of, add duration to essentially the government's the bond market, therefore should also add some more upward pressure on yields in the long end. I think there's just appetite here to buy because of uncertainty, and that's why we've seen treasuries at the long end bought. But the fact is that all the policy mix that we're seeing announced at the moment, the possibilities there generally mean higher long end yields. So I don't think they stay down here for long.
Bloomberg Market Live executive editor Mark Cudmore, we thank you so much, of course, for breaking down the market reaction off this tariff thread. You can get more analysis from him and the team, MLIV Go, on your Bloomberg terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So I'm going to have my eye on the Mexico-exposed stocks in particular today, given the news we've had in terms of tariff coming out of Trump overnight. Now, remember that BBVA, as was being discussed on the show earlier, this stock was hit hard as Trump won the election a few months ago. That dropped down a few weeks ago when Trump was victorious. So we'll be watching BBVA today in Europe. But it's not just the banks. There are a number of other sectors. Now, the beer makers, AB InBev, has a couple of Mexican brands, including Modelo, the biggest Mexican beer brand over in the country. Volkswagen as well makes cars and sells them into the US across the Mexico-US border. Meanwhile, Tenaris, the Italian steelmaker, also has operations there, and Iberdrola, the Spanish utility company, is exposed to Mexico as well. So I'm expecting all of them to be in the focus this morning. Then in terms of pharmaceuticals, a couple of bits of news coming out of Roche today. Firstly, they are doing a bit of a takeover in the US. This is for a gene therapy company, which is called Poised Therapeutics. A massive premium on that deal. It's at around $9 a share, so that one should be rising in the US later today. But for Roche, we've also had news on a lung cancer drug study, and it doesn't look positive according to the analyst take on this. The key words from the statement is that the study did not reach the primary endpoint in the final analysis of that lung cancer drug trial, which is pretty keenly followed, so that one's set to be weaker today. Then in terms of earnings, we've got Compass out of the UK, a massive firm, a $50 billion company that does catering around offices and also airports as well. We can see pretty steady in terms of the stock for that one. But in terms of the earnings today, looking a little bit soft on some of their guidance, and there's no share buyback. Morgan Stanley says that is a negative, which will drive Compass lower today, according to their analysis. Then finally, on the ratings changes, here in the UK, we've got Next raised to outperform at RBC. Deutsche Telekom also has an outperform, that's over at Oddo. And finally, Amundi cut to neutral at JPM. That one is linked to the UniCredit news that we had yesterday.
Joe, thanks very much. Our equities reporter, Joe Easton, with a look at some of those stocks that could be on the move. We've been captivated, haven't we, by this European futures picture. Should mention the US futures actually flatlining now, so there does seem to be a little bit of a rethink just at the margin there. But European futures are weaker, aren't they? And there does seem to be a sense that European autos trade weaker. I've been looking at the various auto companies in Europe that produce in Mexico, but that might be pointless because it might just all be about the threat, the vague threat of more tariffs.
Yeah, we talk a lot about the auto space. I feel like luxury is also one that could get hard hit this morning. When you look at the futures picture, the CAC 40 is taking a bigger hit than the DAX is. When you look at the futures picture, almost double the hit. And I should say, I'm trying to figure out how that applies, though, given that so much of the luxury space has been impacted by the Chinese stimulus story and the consumer story as well. Does tariffs really change the needle for the luxury space in France? That's I don't know.
It's an obvious and interesting target, particularly the drink sector in the past has been used by US administrations as a place to go when it comes to tariffs. So you think the UK market, though, is getting away with this a little bit. It's not being hit to the same degree that we're seeing elsewhere. Is that because the UK is a services sector economy, therefore doesn't get hit by the goods tariff? I don't know is the honest answer to all of this.
I'm sure if I go to the ECTR function on the Bloomberg terminal and pull up the trading relationship between the UK and the United States, I see that there is a lot less.
We run a goods deficit with the United States.
Yes, and so this will be less of a flashing red light on President Trump's dashboard, one imagines. So that could be part
picturing the dashboard.
Yes. It involves a lot of US stocks, I think. We could build one, couldn't we? We could send one. We should send a suggestion.
We'll help out. We'll help them out.
We craft that, send it over to the White House. They've got Bloomberg terminals. They could run it there.
I bet they're watching right now. I bet they're tuning in right now. I think this is a crucial one, though, because I almost am curious if this almost incentivizes some of the conversations with China from the European perspective. If you're saying, well, maybe tariffs from the United States are coming down the line, does that increase the need to maybe negotiate faster and sooner and with better conditions on things like EV tariffs, for example?
Don't know, but how many battles can you fight at the same time?
Institutional sort of capacity starts to become an issue when we talk about all these trade.
And this is where I think the UK is a problem. Has a problem here.
And that was something that was very much a feature of the first Trump administration. There seemed to be so many fronts and governments around the world having to respond on so many fronts to the Trump administration that, that's something we also have to remember from 2016.
But Mark put it quite nicely there. You're reactive. The tariffs come in and then you react to them and then you negotiate them with whatever ultimate outcome he's looking for. That seems to be the way that the market is going to have to approach this. Anyway, futures currently pointing negative here in Europe. We're still scratching our heads to try and get to the bottom of that. Tuesday morning, a couple of minutes to go until the start of equity trading, cash equity trading here in Europe. In theory, this chart here would suggest that European equities tick a little bit higher this morning. So we close here. US equities kind of bounce along the bottom, near the bottom of the trading range in the United States in the afternoon session, then tick a little bit higher into the close. There's not an obvious reason why, from this chart, why we're seeing what we're seeing in the futures, Kriti, because the futures are down, but this chart suggests that maybe we should be a little bit more neutral.
It certainly does. And when we look at the futures picture, you are seeing red on the screen here, down about 0.6%. FTSE 100 down about 0.4%. This is important when we talk about that revamp because the stock 600 in Europe, as you pointed out, was down. It's down again. A lot of that's going to be the tariff read-through. And we see that in CAC 40 futures. We're also seeing that in DAX futures. This is the closing price of the DAX, but I think it shows well that you did see green on the screen yesterday. So maybe, Guyana, this is a little bit of maybe just a pullback or retracement of the green we saw yesterday.
Yeah, so retracing some of yesterday's gains and also mindful of what we've heard from President Trump overnight then. Just saw that futures picture tick over behind you there, Kriti, to suggest that we are, of course, expecting some weakness over in Germany. And some of that could come from the auto sector. Trump tariff-exposed stocks are certainly in focus. Is that because some of the auto companies in Europe actually manufacture in Mexico, or is that because of a general thought process that goes, well, President-elect Trump is talking about tariffs against various parts of the world. He'll be talking about Europe soon. Roche is also in focus. The drug maker shares could be a little bit lower today on the back of some lung cancer news out of that company. The Compass Group catering company, their numbers not looking so bad, but the guidance and a lack of a buyback, according to Morgan Stanley, could weigh on the shares, Guy.
Let's take a look. Here we go. See how some of those single stocks will affect the market open, or does the macro top-down Trump trade exert a greater influence? We are expecting negative numbers to be posted straight out of the gate. The FTSE 100 is down, not by much. We're expecting maybe 0.3% of 1% lower for the FTSE 100. Do we see bigger numbers being posted elsewhere to countries that maybe could see greater exposure to that Trump trade? At the moment, that doesn't seem to be the narrative. Maybe the FTSE does fall in line with the wider European story. Does that allow us to question whether this is tariffs or whether it's simply something else? So here we go. The FTSE is down by 0.2%. The Stock 600 is down by now 0.4% as the CAC 40 opens down 0.8%. The IBEX is down by 0.8%. But maybe that does take us back to the idea that maybe the FTSE 100 is less exposed. We'll see how the DAX opens in just a moment, but we're still scratching our heads. Is this simply us pricing in the risk of tariffs being applied to Europe by the Trump administration? despite the fact that Europe wasn't even mentioned in the post that we saw yesterday from President-elect Trump.
Already some sensitivity, though, that we're seeing in the French markets, as the futures picture suggested earlier. Your biggest index contributor to the downside is LVMH. It's luxury. It's the read-through there. As Guy mentioned, we're still waiting on some of the German names as well. But when you look at some of the tech sector for Germany, I'm looking at SAP, for example, is one of your downside movers. Anna, ASML is one of your downside movers when it comes to the tech space. I'm curious how much of that is the China exposure as well. And on top of that, this to me is the Trump trade very clearly, and that's BBVA. That has so much Mexico exposure. It's getting hit pretty aggressively and dragging down the stock 600 with it.
Yes, and you can certainly see when you look at the broader sector picture, everything is in red. No sector is in positive territory right now. Autos and parts, as expected, that is an area of weakness, and that is the worst performing sector. Stellantis, Valeo, BMW, Volvo, all down by more than 1.5%, as is Mercedes. So broad selling across the auto space. And as we said, is that, some of those companies do manufacture in Mexico, but there is just the broader thinking. If we look at other sectors that are in focus, consumer products and services is weaker. There's Compass in there, and that was one of the ones that we talked about at the open. That particular business down by 3%.
LVMH is down by 1.6, biggest points drag on the stock 600 this morning. So maybe this is, again, the area that Trump may focus on, or market extrapolating an area that he may focus on. The bigger question here is, though, I keep talking to guests, and they keep telling me that all the bad news is in Europe, that Europe is super cheap, that this is as bad as it gets. But it keeps maybe getting a little bit worse.
Yes. Well, this is a really interesting question. The extent to which markets have priced in any geography what a Trump presidency means, because knowing what a Trump presidency means is very difficult. And if you price everything, if you price in word for word, surely that is not priced, is it? I mean, this would be something we continue to have conversations about.
Well, as we speak, the DAX has opened, I feel like a minute earlier than it usually does here. But you are seeing, of course, the car sector really take a beating this morning. So Daimler Trucks is your biggest percentage drop that you're seeing in the German index, down by about 3%. But BMW, Volkswagen, right on its heels. You are, however, seeing defense stocks actually in the green in the DAX. So that feels to me like a Trump trade right there.
That seems logical, doesn't it, though? In some ways, this again is an idea that Europe is going to have to stand on its own 2 feet.
I'm sorry, is the market right? What?
The market's always right.
Well, let's bring in a guest who can maybe give us a little bit more insight here. Julius Bendikis, Europe head of macro and dynamic asset allocation over at Mercer, joining us around the table. I'll put that question to you. Is the market right, or are they overreacting?
I think European equity market is reading into a lot of things right now, but I think it's fair that it's actually underperforming. And I've been trying to solve that puzzle all morning myself, but I think when China coughs, Europe catches a cold. When US coughs, Europe catches a cold. And right now, the fact that there's conversation around more tariffs on China and the fact that yuan is weaker, that makes Chinese exports a little bit more competitive. So that is a headwind for Europe. Then if there's a headwind for China because of tariffs on Chinese growth, that is a headwind for demand for European goods, and that's why you're seeing a bit of a pullback in luxury stocks. You also have the French politics, which could be a bit of a headwind on market. And at the same time, when US applies tariffs on other countries, that is also a headwind for the US growth. And Europe depends on US demand. So I piece these things together, and it sort of adds up to a bit of a pressure on European stocks, which I guess that's why maybe they're pulling back this morning.
Well, as we speak, you kind of talked about the fundamentals there and piecing it all together. At the same time, we are getting headlines from the ECB's Guindos as well, talking about that weak growth is one of the main risks that they see now. They're again talking about getting inflation on target. Is inflation still a problem right now, or has the narrative shifted?
I think in Europe, inflation is a problem broadly resolved. The labor markets are rebalancing, and there's certainly, downside risks to growth, which could lead to lower inflation and therefore trigger a more dovish ECB. So I think in European inflation is a problem resolved. I think global inflation, particularly the US inflation, is a problem being resolved, but there's some risks to it, as you might expect coming into next year because of the new administration.
Julius, what do you think? Help us understand what is and is not priced when it comes to trade tariffs around the world, because the market, I guess, knows better than to take every statement on tariffs at face value and price that in directly. And so that takes us to a situation where some argue that tariffs are priced and others argue that tariffs are not priced, and they both could be right, but they're arguing it from different perspectives. What do you look for the market to price in on the tariff front?
I guess right now market is pricing the risks around it. No one can be certain because, numbers can change. So it depends on actually when things get announced, then the market will be very sure. Right now it's just speculation, and every day the narrative changes. So I'm just looking, for the volatility around the narrative, tweets, and all of that will trigger just market vol. Do I want to make a big directional bet on a tariff? Right now, no.
Right.
I think the market has priced in quite a bit, but probably not fully.
But do you know enough about the Trump administration and its priorities to come up with a strategy around, for example, European stocks? Maybe not this sector, because this sector is going to be hit by tariffs of some magnitude. Maybe not this sector because some other impediment will find its way there. What are you thinking about when it comes to European asset allocation and Trump?
I try to design a high-level sort of vision for what the administration might do. Stuff on tariffs, stuff on immigration, stuff on global politics and geopolitics. And it's still a fairly broad picture, so we don't know where we're actually going to land. So right now, I would say I'm being a bit more cautious, and I'm not making major macro bets on Europe, whether it's in equities or bonds, and pulled back that risk over the last couple of months. And then I'll react as things evolve, because right now it's still a lot of uncertainty. It is much more than before, and we have to take a few pages from the playbook back from 2016. And at that point, being a little bit more cautious was probably the right thing to do. We're all focusing this morning on the risk that Trump poses to Europe and the threat that comes from the United States. Isn't the danger inside the house for Europe? Shouldn't we be looking more internally to the risks that currently are posed by European politics? Germany's all over the place right now. There's a note out this morning from Steve Barrow over at Standard Bank, too big to bail, talking about a Greek-style situation in France and how you could see political collapse followed by a debt crisis that could really roil European markets in a way that we haven't seen for a very long time, and maybe even greater than what we saw in the European debt crisis. Are we underpricing the risk in the house rather than the risk outside the house? Well, there's always something wrong with Europe. That's the old adage, and let's just remember that. But this is quite a big. This feels like it could be quite substantial. I don't have too much sympathy with sovereign debt crisis number 2.0, but never say never. There's risks. But at the high level, I think yes, politics are not great. There's a lot of sort of divided. There's not enough political will to do structural change. And I think European manufacturing sector is weak. And there's a lot of risks coming from the trade and from China. But people talk about all the risks being in, that Europe is super cheap, that equity markets here are... We've never seen such a huge spread with the United States, and it can't get any bigger because valuations are rock bottom right now. Do valuations get cheaper if the French government falls by Christmas? Is the potential for... Or does that just get felt through the currency channel? Does it get felt through the equity channel as well? I suspect it could be a little bit of both, but you're right in saying that European equities are very cheap. And if there is a ECB that is very dovish, or if there is a sort of negotiated trade war truce, there could be a cyclical pickup in European equities versus others, and there could be a bit of a catch-up. Is that a tail risk or a central? I would say there's more a risk around the corners rather than something I would bet on centrally. Okay. However, Europe can outperform, but for it to catch up properly, you need to see structural change.
Do we still need to be factoring in what happens in the budget? I mean, Guy kind of talked about that a little bit in terms of France and the ripple effects there. You mentioned a financial crisis as well. It feels like that narrative has completely come off the table. I think the risk is there. There's going to be a lot of volatility around it, and the spreads between France and Germany can't pick up. But people aren't trading it. They're like, I mean, it feels like a very complacent area relative to the volatility elsewhere. Again, to Guy's points. I guess the market has a lot of big fish to fry right now, and probably French politics is downright the pecking order with, the new administration, China response being top of mind. So maybe there's something the market is overlooking, but again... I think we fry fish, not the French, but yeah.
How inflationary a world are you preparing for then, Julius? Just broadly, there's been a lot of conversation about what Trump will mean for inflation, but even before a Trump presidency, a lot of people were lining up reasons why inflation might be more elevated than it was, post the GFC, and we will never go back down to those kind of levels of inflation. What are you preparing for?
Well, before Donald Trump got elected, I was lining up for disinflation to continue because I had a lot of confidence that the wage growth is indeed coming down. And from the conversations with our careers team in the US, that narrative is reinforced, with executives penciling about 3.5% wage growth. When that happens, that is consistent with inflation at 2%. So I was very comfortable with the disinflation narrative, and I was certainly pushing back on those who argued higher for longer for inflation. If anything, you could argue for higher for longer for rates to ensure that inflation is there, but I wasn't too worried. Right now, I think there's some risks around the edges. Coming from tariffs, there could be a one-off pickup in prices. If there's a big disimmigration from the US, there could be some pressure on wage growth. And fiscal stimulus at the time when the economy is arguably close to capacity, that is potentially inflationary. So risks have elevated, but as long as I see wage growth coming down, which has been the case, I'm fairly comfortable.
Nice to see you, Julius. Thanks for stopping by to see us. Joining us around the table this morning, Julius Bendikas, Europe Head of Macro and Dynamic Asset Allocation over at Mercer. Picture doesn't look particularly good out there of your long-risk assets this morning, particularly when it comes to the centre of gravity here in Europe. Let's take a look at the core 6 and figure out exactly what is happening. As you can see, significant amounts of red on the screen. LVMH seems to have come off its lows, but as you can see, there's an awful lot of weakness out there at the moment. Schneider Unchanged looks like an anomaly. I'll come back to that one in just a moment. Let's get some other moves, figure out what is happening here with Joe Easton.
So it's all about those tariffs today, Guy, particularly over on the Mexico exposed board here. As we said earlier, BBVA does have big Mexico exposure. It did drop after Trump was elected, so that one coming down 2.4%, as is AB InBev, the big brewer that has Mexico operations. Tenaris in the metal space, and also Daimler Truck, all of them with Mexico exposure. Daimler Truck in particular exposed to Mexico, coming down 4.3%, but the auto sector in general is weak today on the broader Trump concerns, of course. Then we will flip over and check in on the drink sector more broadly, because I also wanted to mention Heineken, which does also have some Mexico exposure, and Diageo and Pernod. Potentially that part is more related to the China risks around the tariffs there, given the big market for both of those companies. So really all about the tariffs today. Then in terms of the single stocks, we have got Roche on the radar, and there it is coming down. They've done a takeover deal today over in the US, but also weak lung cancer drug study results. They have missed the primary endpoint, and that's weighing on that one this morning. And also in the UK, we're looking at Compass. That one was called lower by analysts over at Morgan Stanley, and they've been proved correct, because that one down 2.9%. That is a strong and steady stock. The airport catering, office catering company, no buyback is the comment from Morgan Stanley that seems to be weighing on that disappointment around capital returns for Compass. Then finally, wanted to bring up this morning call on a Monday, because this relates to the Italian banking news that we had yesterday. Now, Amundi actually has a deal with UniCredit on asset management, and analysts over Exane saying that this pact potentially comes into focus under threat if the deal between UniCredit and BPM does go through. So they've got their eye on that one. And Amundi falling today, down 2.5% over in Paris.
Joe, thank you very much. Joe Easton from our equity team there with a look at some of those analyst moves and indeed other stocks and sectors. And I'm glad he pointed to the drink sector, because I'm not sure we've given that one enough coverage this morning. 8:13 here in London, 9:13 if you are over in Germany, and it will be to Germany that we will go next. Germany's industrial downturn deepens, with Thyssenkrupp steel unit planning to cut 40% of its workforce. We will feed that into the wider conversation of German industrial woes. That coming up next from Berlin. This is Bloomberg.
Welcome back. You're watching the opening trade, 17 minutes into the equity market session. This is what we're looking at across Europe. It's interesting, actually. It's a reasonably even story, as you can see, in terms of how we are trading, and kind of the evenness across Europe, I think, is fascinating. The market is just pricing Europe as a kind of blob this morning. It is exposed to the Trump tariff trade story. There are some specifics around what is happening with luxury. There are some specifics around what is happening in the auto sectors we've been talking about. But Europe is being, despite not being mentioned by Trump, heavily impacted by the Trump story overnight. This, as we continue to watch what is happening with French and German politics, which in some ways are big stories in Europe that aren't being talked about a great deal. So let's talk about them now. Alan Katz is in Paris. We need to talk about what is happening with this French budget and whether or not the current French government survives until Christmas. Ollie Crook is in Berlin on Germany's macroeconomic troubles. Let's start with you, Ollie, and talk about what is happening here. More bad news. It keeps on coming. The latest being the German conglomerate Thyssenkrupp announcing plans to reduce staffing at its steel unit by 40% over the next decade. Just reflecting in some ways the challenge that so many of these big German industrial companies face right now.
Yeah, Guy, and not just reflecting it in sort of a broad sense, reflecting it in a very real sense. Because again, we've talked about it for a number of years now, more than 2 years, manufacturing contraction in Germany. We look at the PMI charts. We sort of have an illustration of what that means on paper. Again, what we've got in the last couple of weeks is that being illustrated in the real economy, Thyssenkrupp being the most recent. And we're talking huge numbers here. We're talking about 11,000 job cuts over at Thyssenkrupp, that as you said, 40% of the steel unit. That comes after Friday. Bosch announced 5,500 job cuts. A few days before that, it was Ford in Europe, 4,000 job cuts. And then that doesn't even touch the Volkswagen job cuts, which are going to be probably closer to 10,000 to 30,000 job cuts. So in sum, we're talking somewhere between sort of 30 and 50,000 job cuts, broadly speaking, across the German economy, announced over just the last couple of weeks. And these are not small companies, right? These are companies, many of whom that have been operating within Germany since the 1800s. Trying to appraise where we are in the cycle is the question that I'm asking myself. Where are we? Are we at the beginning of job cuts? Are we sort of towards the end of it? I talked to Carson Bresky yesterday, who's really been sort of out in front on analyzing what's been happening in this economy, really got it right, a couple of years back. He says he feels that we're right still in the center of this. There is still more pain to come. We still, for example, have not heard from BMW, from Mercedes. We haven't had any job cuts there yet. And I think another thing to pay attention to is it's not just the big companies. We had an IFO survey out a couple of days ago. The share of German companies, remember, SMEs are huge in Germany, huge part of the economy. So the share of German companies that fear acutely for their economic survival has risen to 7.3%, up from 6.8% just last month. So again, this is sort of continuously on the downturn and hard to see an exit anytime soon.
And how is this going to shape the election or be reflected in the election then, Ollie? Because it must be part of the overall national narrative at this point.
Absolutely. I mean, I will say that I probably wouldn't want to be the incumbent coming into this election with a couple of weeks to go and basically, tens of thousands of job cuts coming in. It will really speak to some of the detractors of Olaf Scholz, the SPD, and the coalition, saying that they've basically mismanaged the economy. I mean, this could go a couple of ways, right? On the one hand, this could really help the sort of Germany first parties, the far right, the far left, really saying that Germany needs to prioritize itself. It needs to push everybody away and really needs to continuously, focus on itself. That being said, the AfD and the far left, they don't really have the sort of economic chops. They don't have the reputation for dealing with the economy. So likely this could continue to support the CDU, which you can see is still sort of way out in front consistently. The problem is that Merz is basically, in terms of his growth philosophy, it's basically cutting tax, cutting bureaucracy, cutting regulation, cutting benefits, cutting pensions. But that does not fix the underlying problem here. The underlying problem here is that there is not the export markets that there previously have been for the German economy. And when you wake up and you see the sort of tweets, or I should say the Truth Social post by Donald Trump slapping, potentially tariffs at 10% on China. You look at Mexico and Canada. I mean, Germany has been really enemy number one for the Trump administration the last time around. That does not bring any sort of reassurance. So the question for the Germans here is, yes, you can have these sort of tweaks here on the taxes and this, that, and the other. That could boost growth in the medium term. What you're failing to have is owning an industry that's really following into the future, particularly with the auto sector falling behind on EVs. And that is what the Germans need to sort of determine. What are they going to be competitive with the Chinese and the United States? And that is a question they have not yet answered.
Industrial concern in Germany spilling over into politics. Politics in France maybe spilling over into industry. Ollie, thank you very much indeed. France's far-right leader, Marine Le Pen, renewing her threat to bring down the government in a no-confidence motion over next year's budget. The move, of course, compounding uncertainties that are pushing up measures of risk on bond markets to fresh highs, the spread between OATs and Bunds. We're joined now by our Paris bureau chief, Alan Katz. Alan, is it now the base case that Le Pen is going to bring the government down, she will vote against it, and the Barnier government will be gone by Christmas?
I would hesitate to say there's any base case. It's really unclear what her ultimate goal is. The reason being that for several months, Le Pen and her troops sort of said, we're going to be responsible people. We're going to, we're not going to bring chaos to France. And then suddenly, in the last couple of weeks, she's really shifted, including yesterday, to a much harder tone, suggesting that she could, in fact, as you mentioned, bring down the Barnier government over the budget vote in December. And the question is really, to what end would she do that? And it's not really clear how it would help her. Now, on the sideline of this, there's a separate court case against her, which the judges could rule that she would be ineligible to run for 5 years, which would throw up into question her presidential ambitions. Is that what's sort of pushing her to be harder or harder against Barnier? That's possible. But the question again is, like, how does it really affect her, unless the goal is really just to remind everyone in France, judges included, how much she matters right now. And that could be the thing that's sort of pushing her to do it, or at least to threaten it. It doesn't necessarily mean, though, that she will actually do it, which is why I come back to the issue. Like, I'm not sure there is a base case. We really don't know how she's going to play this at the end of the day.
So, Alan, what does Michel Barnier do in this situation? What can he do to get this budget across the finish line?
So he will probably need to give her some sort of fig leaf, right? He will have to. The budget right now is with the Senate. There will be the French equivalent of what in the U.S. you'd call a conference committee, where they sort of negotiate between the Senate and the lower house, which is called the National Assembly in France, to try to come up with some sort of compromise solution that will probably not really go anywhere, and then the government will be able to pass it through this constitutional measure called a 49-3, which allows it to just adopt the thing without an actual vote. And what that allows you to do is you can adopt essentially any version of the budget that you want, either the very original version that you put in, or something with a few amendments added in. It's as you like. And so in that process, he could then add one or two sort of, little budget gifts, essentially, to Le Pen in order to say, like, look, I've agreed to your desire for this thing or that thing, therefore you should help me out. And that would allow Le Pen to say, like, look what I got out of the Barnier government too. So that might be a solution. That said, she might say, no, I'd rather actually have you overthrown and sort of recreate political chaos in France. It's really hard to tell.
Alan, you give us a really good explanation, including talking about the court case and asking lots of questions about why her thinking might have changed here. But her thinking up to this point has been, we've been trying to reinvent the national rally, the National Front as was. We've been trying to reinvent it. We want to present ourselves as serious. Therefore, the idea that we would just rashly bring down the government, maybe that's not the thing we want to do. We want to keep our powder dry for another presidential election. So do we sense that thinking has changed?
Again, it's really hard to tell, because it could be just purely brinksmanship on her part, with the idea of saying, I just want to remind people how much the national rally really matters, and why it has become the kingmaker, because you have this left bloc that's in absolute opposition to the government. They'll vote to try to bring down the government at any point, and so that leaves the RN as the kingmaker. So it could be just bluster, essentially, or it could be serious. And again, France doesn't have a real history of parliamentary, not in the last 70 years. For a long time, has not had a real history of parliamentary democracy. It's been much more like much more of a presidential system. So it's uncharted territory for France for quite a long time. Okay. So it's really hard to tell how people will react.
It really is. Alan Katz, thank you so much for providing us with that explanation from Paris. Coming up on the programme, we're going to talk about digital assets, their future in the UK, regulation behind them, as we get ready for another Trump presidency. This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. Red across the screen. It feels like this is, of course, a reaction to what we're seeing from President-elect Donald Trump in the United States and his comments around the tariff story. He hasn't specifically mentioned Europe yet. He's talked to Mexico, Canada, China. But it feels like Europe is taking the brunt of the market reaction, specifically when it comes to luxury and the auto space. Euro Stoxx 50 down by about, well, we'll call it 1% if you round up. FTSE 100 right on its heels, down by about 0.5%. There's a lot going on in terms of how we navigate all of this. The UK UK seems to be a little bit of a relative safe space. And I really underline the relative safe space when you talk about this market reaction. I wonder how much of that will change in the coming months. I want to stick with the UK, though, and talk about the most powerful business lobby that has warned the government that it is in danger of losing the trust of corporate leaders if it fails to mitigate the impact of last month's budget. But Chancellor Rachel Reeves has defended that very budget. She told the CBI's annual summit in London that it was important to put the public finances on a firm footing.
I've had lots of feedback on the budget, but what I haven't heard is any credible alternatives to what I did to put our public finances on a firm footing. What I am really clear about, and I've said it already a couple of times today, that public services now need to live within the envelope that we've set. We will not be coming back to top up those budgets. We have set the envelope for public spending.
Get a little bit more reaction off that. Bloomberg's UK correspondent Lizzie Burden joins us around the table. Lizzie, walk us through the reaction there.
Well, it was negative. I mean, I was at that conference last year and Keir Starmer was a rock star. That was, though, when he was in opposition. Now, of course, they've had the budget, £40 billion worth of tax rises, most of that aimed at employers through this national insurance contributions rise. And so the CBI chair, Rupert Soames, is saying you've got to make up for it somehow. And that's why today, in part, we're going to be getting the white paper, Get Britain Working, and Keir Starmer is going to be saying, look, we'll take away benefit spending from people who refuse education or training, and the goal is to get employment to 80%. It fits the message from Rachel Reeves that you heard there of fiscal responsibility, but, you know, it's going to be controversial within the Labour Party in some parts because ultimately that message is, as I once said to you, Guy, get on your bike.
and I did.
And he does, yeah, regularly. We witness. Let me ask you about the BOE Watchers Conference, because that was also happening. So the Bank of England Watchers Conference in London yesterday. Were there any clues there about the impact of an incoming Trump presidency?
Yeah, it was really interesting to hear finally from Swati Dinger on this, because she is the resident trade expert on the Monetary Policy Committee, and she says that because of trade being diverted from China, actually for the UK it could be disinflationary. We also had her joining this collective rant on the UK labour market data. She was born in India, and she says if India can get its jobs data sorted, the UK certainly can, because at the moment it's in the way of the policy making. We also heard from Claire Lombardelli, the Deputy Governor, first time she's given a speech since being on the committee, very much stuck to the script of the last meeting's minutes, saying, yes, they're making progress on disinflation, but the risks are balanced, so they're going to be data dependent. But interestingly, the main thing she was talking about was the Bernanke review, because she's in charge of executing it. She says they're not in a rush to do anything about it, but hinting firmly that she's not up for copying the Fed's dot plot.
Lizzie, thank you very much. Bloomberg's Lizzie Burden with the latest on those UK themes. Sticking with the UK and regulation, regulators are aiming to finalise rules to oversee the crypto sector by 2026. This as the country tries to keep pace with developments in the US and in the EU. And as crypto ownership in Britain continues to grow, we're now joined by, for an exclusive conversation, by Matthew Long, Director of Payments and Digital Assets at the UK's Financial Conduct Authority. Matthew, thank you so much for joining us. And you put out a report this morning with details of the UK and its relationship with crypto markets. In there, we see 12% of UK adults now own crypto products. This is ticking up slowly. Just spell out for us, because I think it's useful to keep saying, how much protection do those holders of crypto assets in the UK have right now?
Yeah, thanks very much for having me this morning. At the moment in the UK, there is a money laundering regime and some financial promotions protections, but there are no protections for those that invest in crypto. So, unfortunately, if people do invest in crypto, our message is be prepared to lose all your money.
Be prepared to lose all your money. Well, that's an interesting place to start our conversation. And I'm taken by the fact that, you know, you've been doing this for a couple of years now. Your background is in financial crime. Is that where your priority is then when it comes to regulating as opposed to incentivising the crypto industry?
Not at all. I mean, any regime has to take account of all of the different ways. We want a safe market and we want consumers to be protected. So what we're delivering is a regime that started with money laundering, because that's where some of the threats were. It then moved into financial promotions, where we're making sure that customers could see good messages and safe messages, and then we move on to the wider regime. So the wider regime, as you've said, is coming in 2026, and throughout next year, we've got discussion papers where we're discussing with industry how we're going to build a great regime, and then also consultation papers where we're going to say what the rules might look like and give people the opportunity to comment. So I've had many really good conversations recently with industry about how we're going to learn from MiCA, learn from other regulation around the world, and bring a great regime for the UK.
Matthew, is the UK behind the curve? The Americans are talking about a strategic stockpile of Bitcoin. We're still dealing with the kind of regulations that are going to protect retail consumers. We appear to be kind of watching everybody else make the running on this. Why is the UK taking this more circumspect strategy, dealing with this more circumspect strategy that you're outlining?
Yeah, I don't think we are behind the curve, and I don't think it's circumspect. I think what we've done is we started with stablecoins as the previous government asked us to. That's now been moved into one regime by the current government. So we're responding as we would as a regulator to the government requests, but we're working directly in the global market as well. So I currently chair the IOSCO work on behalf of the Securities Organization, which includes the US, includes MiCA countries. And within that, we come up with 18 global recommendations which we're implementing globally. So so what we're delivering at the moment is a regime in the way that we've described it that will be ready and good for the UK. But I directly work with the US and directly work with MiCA colleagues.
The other day at the Mansion House, the Chancellor talked about the fact that regulators maybe were standing in the way of growth. Is that a message that you've heard? Is that a message that you think regulators more broadly should be hearing?
So as a regulator, we have a secondary objective for competition, and it's a key part of what we do. We absolutely are committed to competition. In terms of growth, our job as a regulator is to make sure we're taking account of growth, and it's one of the things that have been written to by government to make sure that our plans include it.
Matthew, it's Kriti in London. Talk to us a little bit about how the crypto story and the crypto regulation comes either in tandem or in contrast to some of the moves in central bank currencies, CBDCs. We know that the digital pound is something that the BOE is talking about. A digital dollar, certainly something the Fed is talking about. A digital euro already exists out of the European Union. How are you viewing the contrast between CBDCs and crypto?
So in terms of the direction of CBDCs, you'll see that the government has particularly asked the Bank of England to do some work on that, and we'll directly work with the bank in that. We also consulted in our regime about stablecoins and then systemic stablecoins. So obviously what we're making sure is we think about the role of stablecoins and CBDCs. So ultimately we support the work of the Bank of England on CBDCs, but we've also looked at other options which are stable coins and how we would work between both the conduct regulator and then ultimately the Bank of England.
So, Matthew, I'm going to continue with that concept of kind of international currencies as well. There's a lot of foreigners living in London, myself included, who are looking at a weakening pound as well and saying, well, maybe, this is not my personal view, but this is one that exists in the narrative, maybe if you are looking at a dollar strength and you're an international investor that's being kind of affected by that, maybe crypto as that store of value is the place to put your money, except the government or regulators like yourself are getting in the way. How do you respond to a question like that when other currencies, more traditional currencies, are weakening?
Yeah, I understand particularly the challenge that you're facing and the discussion that you're having. Ultimately, we haven't got a regime yet. So we haven't got a safe market from our perspective, and we haven't actually got the consumer protections that we think you would want to make investments. So that's why, unfortunately, our message is still about, buyer beware. If you are going to invest, you've got to be prepared to lose your money. What we are doing, though, is making sure through the money laundering regime and the financial promotions that we are putting good safeguards in place. And as we get towards 2026, there will be a better market and more protections for you. So my message at the moment is still be very careful with any investments you make, as any investment, but particularly in crypto, because we haven't got the protections that you can afford to in the UK.
Well, Matthew, you mentioned that kind of buyer beware dynamic, and we've seen this show up in the likes of exchanges, for example, in the United States. Robinhood has come under a lot of scrutiny about this, given their exposure. Are you partnering with the likes of Robinhood, among other kind of crypto exchange operators, to help create that education? What does that dynamic look like?
So, of course, I won't make a comment on any current applications or any activity with particular firms. But what I will say is that we are meeting with all of the significant industry bodies and the industry partners to work through what the regime should look like. I think that it's really important that when we build this regime that we've taken forward what is going to be helpful for the country, but particularly also that we think about that dynamic where companies are based all around the world. So we have to be open for good regulation globally.
So back to where we started the conversation, in a sense, Matthew, the fact that we see increased ownership of crypto by adults in the UK. Are we seeing this normalisation of crypto ownership taking place in a way that the FCA is comfortable with, or is that a decision for government?
Yeah, it's not a question of whether I'm comfortable or whether we're comfortable. It's a question about our research is so that we can keep our finger on the pulse in terms of what consumers are doing and make sure that we prioritise where we can make consumer activity safe and also take into consideration what the market should look like going forward. So I think it's really important that this research tells us today the volume of people and that we respond to it. That's why we do the research, so that we can have conversations with you today to actually get our message out and make sure we build a really good and safe regime.
Thank you very much, Matthew. Good to speak to you. Matthew Long, Director of Payments and Digital Assets at the UK's Financial Conduct Authority. Coming up on the programme, the EU proposes sanctions on Chinese firms as the G7 prepares to increase pressure over alleged support for Russia's war efforts. More on those measures next. This is Bloomberg.
Welcome back to the opening trade. We're about 45 minutes into today's session, seeing red on the screen and continue to talk around some of the tariff impact that we may see out of the United States currently showing up in Mexico, Canada, and China when it comes to those comments from President-elect Donald Trump. Could Europe be next? And what industries get caught in the crossfire? Right now, you're seeing that showing up in the French and the German indexes, auto and luxury getting hit especially hard. But outside of that conversation, there's some other movers you want to keep an eye on, specifically in the banking space and the Italian banking space in particular. UniCredit down about 1%. Banco BPM, on the other hand, higher by 0.9%, all from some headlines, some consolidation, but not consolidation, right, I think is the way to put it.
Yesterday, the story was all about UniCredit making a play for BPM. And we were mindful yesterday in our conversations that Crédit Agricole owns a stake in BPM and wondering whether that might, they might have something to say about this. They've been making some comments this morning saying that UniCredit didn't ask permission to exceed, they have not asked permission to exceed their 10% stake in BPM. So that doesn't suggest perhaps that they're in a rush to come forward and make some kind of counter offer. But there is a lot of chatter, and this has been picked up by the Italian media, about whether Crédit Agricole themselves might have somehow, through some derivatives, again, this is all rumours on trading floors, quoted in the Italian media, but it does seem to be moving the share prices, whether they have increased their stake in BPM.
We don't know.
A lot of smoke.
A lot of smoke. How much signal is there in the noise in around all of this? We don't know yet. We were caught by surprise by the UniCredit move once again. What does it ultimately do? I suspect the UniCredit has its objectives here. We don't know whether it's Commerzbank. We don't know whether it's BPM. We don't know. It could be another bank entirely. It does seem as if Orcel is on the move at the moment, and certainly that's having an effect. But how does everybody else react to it? Is he the Donald Trump of European banking at the moment, catching everybody by surprise and basically kind of forcing everybody to react in a way that they hadn't expected to? Or is Crédit Agricole already looking forward to this and is positioned for it? I don't know. The market is really struggling with who is defining the narrative at the moment, and that's been the story of this morning. Who's in control of the narrative? In Europe, it seems to be Donald Trump. In European banking, it seems to be Andrea Orcel.
I'm going to nerd out here. This, to me, I'm having so much deja vu around the BBVA Sabadell deal because ultimately it's coming down to we want the bigger markets, we want exposure internationally, except you get in trouble with your homegrown government. And this is a very story you're hearing from the Italians. You heard it from the Spanish as well. You've heard it from Germany. We're talking about in the break about how you're starting to see kind of protectionism, but on a different level.
Yes, but I suppose there's one difference here. Maybe there's a difference here in the sense that what Orcel is doing hasn't necessarily got the blessing of the Italian government.
Yeah.
So he may be loading up on Italian assets here or trying to, but it runs counter to another plan that the Italian government had, which was to create a different force in Italian banking. We've heard from the Italian finance minister that they have not given their blessing, nor have they withheld it, but they haven't given a verdict yet on what they think of this.
Why don't governments want domestic consolidation? Is it because they want to have enough competition within their domestic market so that actually there's good price competition? In theory, though, cross-border would solve that problem, but it does seem as if European governments are still very wary of cross-border, which makes you it does slightly take me back to the financial crisis and the Eurozone crisis, where that kind of spillover effect from other people's financial crisis was something that Europe had to deal with. And I think a lot of politicians in Europe still bear the scars of that. Why should I take on your banking risk into my markets? Why should I have the spillover effects of your banking?
Yeah.
And that it just speaks to this crisis at the heart of Europe, which is we don't have this single market in a way that you would envisage, which is why we're struggling to make this thing work.
Next steps here, post the government say, is whether or not the ECB gives it their blessing as well. Because at the end of the day, the concerns around this from the domestic side is, yes, we don't want too much international exposure to domestic banks, but you also have that read-through into consumer rates. For Germany, it's an overbanked space. For Italy, for Spain, these consolidations make an active difference when it comes to the actual rates and borrowing and consumption factors for some of these countries, maybe perhaps inhibiting some of the outperformance of the periphery. This is all happening in the background. I think the main topic for Europe right now is what's happening in the defense space. Certainly a topic at the G7 where nations are set to increase pressure on China for allegedly supporting Russia in its war against Ukraine. That's according to an early draft of the communique seen by Bloomberg as foreign ministers, as I said, meet in Italy. Bloomberg's managing editor for European economy and government, Ben Sills, is all over this story. Ben, what might we actually get from the G7?
Well, the main thing we're going to be looking for today is confirmation that they've signed off on this communique that we saw yesterday. That's going to be, assuming it comes through, a pretty significant escalation in their stance towards China. Earlier in the year, they were calling on China to take measures to ensure that Chinese firms weren't supplying the Russian military. Now it's the G7 themselves that are pledging to take action. And we saw last night, off the back of that meeting, that the EU is proposing specifically sanctions on exactly those firms, the Chinese firms that the EU has evidence of supplying drones, supplying microelectronics to the Russian armed forces.
Ben, is this a significant escalation, or is this sort of another iteration of what we've heard before? Help us get some size and scope around this.
I mean, this is the 15th sanctions package that the EU has proposed against Russia. So, in that respect, you know, all of the low-hanging fruit, all of the kind of the most impactful measures have been done there. So it is incremental. On the G7 side, I think that you can see that the split is increasing between the G20 type conversations that we saw in Rio last week, where there is a search for common ground with China, with India, with Brazil, and the rest of the global south, whereas the G7 is very much an alliance in support of Ukraine, and much tighter, and really increasingly willing to show those global kind of dividing lines.
Well, Ben, at the same time, there's a question of how does Europe not only ramp up its defense in the war effort against Russia and via Ukraine, but just for their own defense as well. And some of that is coming out of reporting that France is dropping a buy EU demand when it comes to the defense fund. Basically, other international defense makers can access those EU-funded initiatives. Can you walk us through the logic there? This has been a hard line for France for a very long time.
Yeah, I think this basically boils down to the UK. The Europeans and even the French, who tend to have the most kind of nationalistic, most protectionist attitude towards their industry, even the French realised that if you're going to have a credible European defence strategy, you need to include the British. And if you're going to include the British, you need to include British arms producers, British production, British industry. So I think that's the thinking there. And we see that the main four, the biggest four spenders in EU defence, that's Germany, France, Italy and Poland, were meeting with the Brits yesterday. And that, I think, points to the direction of travel in that respect.
Ben, great stuff. Thanks very much indeed. Ben Sills joining us out of Madrid. Let's get back to the politics from a different angle. The big story this morning, Trump's tough talk on tariffs aimed at Canada, Mexico, China, not necessarily Europe, but European markets having to price it in. Valerie's back around the table with us. Strange morning in many ways.
Yeah, it seemed like the only asset class that had the clear trade was in the dollar, quite frankly.
Yep.
So perhaps, we can draw conclusions from today's price action that the cleanest way to trade these tariffs is just in FX, right? We had a stronger dollar. If you look at how the Mexican peso was traded, it's now weaker by 1.5% on the session. But a lot of this, we have to remind ourselves that a stronger dollar does stand at juxtaposition to another part of Trump's mandate, which is to bring back U.S. manufacturing, to onshore manufacturing. A stronger dollar is a headwind for that. So maybe a risk, I guess, if he goes and pursues stronger tariffs, that he has to do something, maybe something else to combat this dollar move, else he is going to not be as successful in the onshoring move that he is hoping to see.
And I suppose the other thing, we've been reminded about the way that the market trades headlines, but we reacted really quickly and then saw a lot of the reaction unwind, Valerie, which is probably something we're going to keep which we might see replay and something we need to keep bearing in mind as we see more and more headlines from the president-elect.
Definitely. And if we look at how his Truth Social post, when he was talking about the China tariffs, he used the word additional. Does he mean additional to what's already on China or additional to, that bigger 60% number that he already talked about? A lot of that confusion still taking place right now with how this shakes out in the markets. But definitely FX volatility and FX seems to be the cleanest way to trade these tariff headlines.
We will get used to that and we'll get used to the ambiguity. Valerie, thank you very much. Bloomberg's Valerie Teitel with some of the latest on the tariff story, which is looming large over European stocks. All of the sectors in negative territory today. We see some of the markets most exposed, the French, the German, the Spanish markets, all weaker. Autos and parts is the weakest performing sector. That sector down by more than 2%.
To Valerie's point, though, does the ECB just have to cut rates aggressively to deal with the tariff threat that is coming, and what impact could that have on the euro? It's really going to be interesting to see how this works its way through the system and the unexpected bits that the markets are ultimately going to have to price in. But this morning, I just find it fascinating that Europe's at the epicenter of the tariff talk when
and China
it wasn't
was
meant to be.
Chinese stocks were up.
You said mentioned the automakers is showing up in the drink makers as well, not just because one of the reciprocal tariffs from the United States to Europe, it's actually in the liquor space, the whiskey space as well. And so is, by the way, the impact on the China side. So this is where it shows up. You're seeing a bigger hit here where you have AB InBev down about 3%, Heineken, Diageo, I'll add to that as well, Pernod Ricard and Remy Cointreau both down about 2% as well. A lot going on, a lot of red on the screen, some pockets of green when it comes to things like defense and some of the banking stocks. That does it for the opening trade. The Pulse is up next. Probably continue on this conversation of banking consolidation, President-elect Trump's impact on the rest of Europe and the rest of the world. They're going to dive into that next. Stick with us. This is Bloomberg.